Today's lesson will be Chapter 16, Problem 3B. I've pulled up an Excel spreadsheet for Problem 16-2B. We're going to be preparing a statement of cash flows using the indirect method. The example that I've copied from Cengage gives you a comparative balance sheet for the Harris Company. This balance sheet is for the years 2004 and 2003. They've given you a balance sheet, and what they've given you is the amounts for the accounts on the balance sheet for both of these years. These first two columns are given to you. When you prepare a statement of cash flows, you have to do a little bit of digging and make some computations before you actually start the statement of cash flow. And so what we're going to be doing is we're going to be looking at each one of the balance sheet accounts and comparing it from what happened from last year to this year. In order to prepare a statement of cash flows, you need to follow these steps. So we're at step number 1, where we're comparing the amounts of the balance sheet accounts to determine whether there was an increase or decrease in the balance sheet accounts from the years 2000 and Y3 and 2000 and Y4. So we're going to look at column G5 that I've created for you already to save a little bit of time in talking about this particular problem. Again, Cengage gives you these two figures for these years. We're going to start with our assets, and we're going to look at all the balance sheet accounts and compare what happened from 2003 to 2004. So as you can see, in 2003, our cash account was less than it was in 2004. That difference is an increase of $82,320. You simply go through all of your accounts to determine whether there was an increase or decrease in all of the balance sheet accounts. That's what I've done as far as step number 1. This is getting the computations ready so that you can prepare the statement of cash flows. Step number 1 is to look at each one of your balance sheet accounts, compare what happened from the previous year to the current year to see whether there was an increase or decrease in those accounts. Also on Cengage, they gave you some additional information that you need to help you to prepare the statement of cash flows. And what I suggest that you do is you create the entries, the journal entries, for the data in the ledger accounts for these transactions that they have given to you here. So we're going to look at those transactions next. So in transaction A of the given information, they're telling you that they have net income of $524,580. We're going to recreate a journal entry that would be similar to what you would do in the real world. When we have net income on our income statement, the net income comes, of course, from the last line on the income statement. Once all of your financial statements have been prepared, you would prepare a closing entry that will transfer the amount of net income to the retained earnings. Net income will always add to retained earnings. Since they did not give us an income statement to go by, we don't know what the total amount of revenue is. But we do know that when we prepare closing entry, our revenue accounts will be zeroed out. And to do this, we would debit the revenue account for the total revenue. I did not know what the total revenue was, so that's why I put a 0 in for that. We also don't know what our total expenses are on the income statement because they didn't give us an income statement. And because we don't know what they are, I just plugged excuse me, a 0 in as the credit amount for the expenses. We would have zeroed out all of our expenses on the income statement when we prepare closing entry. The difference between our revenues and our expenses is our net income, and net income will add to retained earnings. So when I recreated this journal entry for you, this account called retained earnings will be credited for the amount of the net income. In the second transaction, the B transaction of the given information, they told you that depreciation expense was reported on the income statement. The building's depreciation expense was $51,660. The machinery and equipment had depreciation expense of $22,680. On the financial statements, or actually on their journal, you would debit the depreciation expense for the total of these depreciation amounts. The total depreciation expense for this period is $74,340. Depreciation expense is an expense account which will be increasing. That's why we debit it. And we would also credit accumulated depreciation, which is a contra asset account. Notice depreciation expense and accumulated depreciation does not affect our cash account. So eventually you need to know that depreciation is a non-cash type of entry. So when we get ready to prepare the statement of cash flows, the operating activities section, we're going to have to adjust the net income for the depreciation because there's no cash flow associated with depreciation. The same is true for patent amortization. Amortization expense is an expense account that would be debited as an adjusting entry. The amount of the amortization was given to you at $5,040. The amortization expense will reduce the actual intangible asset, the patent account. So the patent account, which is an intangible asset, is going to be reduced for $5,040. Again, this journal entry, just like the depreciation entry, there's no cash involved in that. But since amortization expense will be reported on the income statement, we're going to have to adjust our income statement for the amount of that amortization expense by adding it back to the income statement amount to arrive at the cash basis for the net income. In the D transaction, a building was actually constructed for $579,600. That means that our building account is going to be debited because it's an asset and it's increasing. Our cash account is going to decrease. And what that means is that this cash decrease, because we bought a building, will end up in the investing activities section of the cash flow statement. In transaction E, we had a mortgage note for $224,000 that was issued for cash. We have received cash because we borrowed a mortgage note. Our mortgage note payable would be credited. When we receive cash, we are increasing our asset account cash, so therefore we debit it. and then we're going to credit our mortgage payable, which is a long-term liability account. Since cash was increased by $224,000, and because we borrowed the money to finance our operations, this cash of $224,000 will show up on the statement of cash flows in the financing activities section. In transaction F, 30,000 shares of common stock were issued in exchange for the bonds payable. They were issued at a dollar amount of $13. And so what this means is we simply exchanged some stock for a bond. So our bonds have been brought back off of the market to decrease bonds payable. We would debit, we're reducing the amount of bonds payable, or liabilities that are out there, by the face amount of those bonds, which is $390,000. You would find the bond amount on the balance sheet that they gave to you. Do you see here we have bonds at $390,000? That's where that amount came from. So our bonds payable will be debited for $390,000 because we're exchanging our bonds. We're reducing the bonds payable. Since it's a liability to reduce the bonds payable, we would debit it. And then in exchange for that liability, we're going to have to give out some of our shares of stock. The common stock is always issued for the total par value. In this case, there were 30,000 shares that we issued at the par value per share. To find the par value per share, again, you would need to look at your balance sheet information. The common stock has a $5 par value. So we're going to take the 30,000 shares of stock and we're going to multiply it by the par value per share. And what that will do is give us a credit for the total par value to the common stock account. Common stock accounts or stockholder equity accounts, they would be increasing in this case on the credit side by $150,000. That $150,000 came from 30,000 shares of stock times the par value per share, which was $5. The difference between the face amount of our bonds payable and the common stock account is paid in capital in excess of issue price over par. The difference in the amount is $240,000. Notice in this transaction, there is no cash involved. So this wouldn't affect the statement of cash flows at all. In G, we've declared dividends at $131,040. When you are declaring dividends, you're creating a liability and you're going to reduce the retained earnings for the amount of the dividends declared. So my cash dividends that we declared was given at $131,040. Retained earnings would be debited. My dividends payable account would be credited. When you declare dividends, you create a liability saying that you're going to pay those dividends payable in the future. Now, what they did not tell you was that you also have to determine how much cash dividends were actually paid. And you will do that through the ledger account. So let's look for just a second at the retained earnings ledger account. Do you see here that the retained earnings ledger account, it has a balance of $2,118,660. That comes from your balance sheet. the beginning balance, and the beginning balance would be for year 3. If you follow it on down to the retained earnings account, you can see the beginning balance for retained earnings is $2,118,660. So put that in the T account to start with. That's your beginning balance. To this, we're going to have to add the amount of the net income. The net income was given in transaction A. It was $524,580. That net income we credited to the retained earnings account, and so it is credited to the ledger account once it is posted to retained earnings. What we also know in this transaction is that we declared dividends by debiting our retained earnings for $131,040. When we do that, we'll debit it to the retained earnings account, which means we're reducing the retained earnings account. If you add the beginning balance plus the net income and subtract out the dividends, it will leave you with the ending retained earnings balance. This ending retained earnings balance is going to show up on your balance sheet. So you can check this balance with your balance sheet account for the current year. And you can see that it matches this amount here. You will also need to analyze dividends payable in order to determine the actual amount of cash dividends that are paid. So we start with the beginning balance in dividends payable, $25,200, and that comes from your balance sheet account, dividends payable at $25,200. And this was for the beginning year's beginning balance. And that's how we get this amount right here. To that, what we're going to show is that we credited the dividends payable account for $131,040. That $131,040 would have been credited to dividends payable. Because dividends payable is a liability account, you would add the beginning balance plus what you had created or declared in the G transaction. So these two are added together. What they did not tell you is how to determine the dividends paid, but they did give you the ending balance. The ending balance comes from your balance sheet, dividends payable account for the current year. $32,760 is the current balance. So what you have as information is you know the beginning balance, you know what you declared in dividends, and you know the ending balance. We have to find a way to determine how many dividends would be paid. When we pay our dividends, we reduce the dividends payable account. So what you're going to do is you're going to take the beginning balance, you're going to add to it the net income amount, and then you're going to subtract the ending balance from it. So these two are combined, subtract the ending balance, and that will give you the amount of dividends that you paid. When you pay your dividends payable account will be debited and your cash will be credited. The cash will affect the financing activities of the statement of cash flows. This is the total amount of dividends that you would have paid out. So before you can even start the statement of cash flow, you have to compare your balances on your balance sheet, and then you have to recreate the journal entries from the additional transactions. Then what I would suggest that you do, which we've already talked about as we went through these journal entries, determine which of the journal entries are going to affect the statement of cash flows. And of course, the last thing you need to do is actually prepare a statement of cash flows. So down at the very bottom of this spreadsheet, I prepared a statement of cash flows for this company using the indirect method. The indirect method will affect the operating activity section. You have to convert the net income to the cash basis. The amount of the net income was given to you in this problem at $524,580. You could also refer back to transaction A. This is where it was given right here. And so that's what we're going to start with on our statement of cash flows. This amount reflects the accrual basis of accounting. We need to convert this to the cash basis of accounting. And to do that, we make adjustments to reconcile the net income to the cash flows from operating activities. What we're going to do is we're going to add back our depreciation expense. The depreciation expense amount was given to you. You can see in this transaction that we created, the depreciation expense amount was $74,340. That was the building depreciation and the machinery and equipment depreciation combined. So $74,340 is what I'm going to have to add back to my net income to convert the net income to the cash basis of accounting. I'm going to look to see if I had any intangible assets. If I do, I'm going to look for my amortization expense. In this case, they gave us the amount of the amortization expense on the intangible asset patent. The amortization expense was $5,040. Since this is a non-cash, it didn't affect cash at all, we've got to add it back to the accrual basis of net income to get to the cash basis of net income. Then we're going to look for any decreases in our current assets. In this problem, we had a decrease in current assets for the inventory account. So I'm going to look to see what the decrease amount was, and we calculated that in step 1. So go back to look at your inventory account, which is a current asset account. This is my inventory account, and you can see that it decreased by $134,680. So that $134,680 is going to be placed on the operating activity section of the cash flow statement. The decrease will have to be added back to get it back to the cash basis of accounting. We are converting this amount to the cash basis of accounting in the operating activities section. We're going to look to see if we have any increases in current liabilities. If you look at the balance sheet that they gave us, there were no increases, so we simply don't do anything with that. We're going to also look to see if there were any losses on the sale of assets. There were no sales of assets in this particular problem, so I didn't put anything there. Then what I did is I'm going to add up all of these additions to the net income amount. When you combine this column together, it gives you $214,060 as the total additions to the net income. Then we're going to look for any deductions, which would amount to any amortization of the bonds. If we look at our balance sheet, we did have bonds, but evidently those bonds were issued at the face amount. We don't have any amortization that is showing underneath the bond account. So we didn't have any adjustments to the bonds payable. So there was no amortization that we would have recorded. We must have issued those bonds at face value. We're going to look to see if there were any increases in current assets. In this problem, we had an increase in accounts receivable, and we also had an increase in prepaid expenses. The two of these increases combined amount to $79,520. The increases are as shown up here in the formula, and we get those from the balance sheet. So that $79,520 consisted of the balance sheet accounts $73,080, the difference in the accounts receivable, and $64,440, the difference that was in the prepaid expenses. So that's how we get this amount. It's a combination of the accounts receivable and the prepaid expenses. We also want to look to see if there were any decreases in our current liabilities. And we had two decreases. We had a decrease in accounts payable, and we had a decrease in salaries payable, which is an accrual, an example of an accrual. And again, we can get this from our balance sheet. We're going to look at accounts payable, and our accounts payable, as you can see, decreased to $89,600, and we also had a decrease in salaries payable. The two of those combined are how we get the total amounts that was entered on the decreases in current liabilities on the operating activities section. Again, in this problem, we didn't have any sales of assets, so that would have been zero. I'm going to combine everything in this column together. That gives me total deductions from net income of $177,240. So we're going to take our net income, we're going to add back the adjustments that we made here, and then we're going to subtract out our deductions from that net income, and then we will arrive at the net cash flow from operating activities. So the three of these combined equals this amount here. So actually our net income cash basis of accounting is $561,400. We adjusted it from the accrual method to the cash basis method. This is the first section of our statement of cash flows, which is your operating activities section. That's the net amount that you get there. Then we're going to look for all of our investing activities. Investing activities can come from cash that's received from either selling fixed assets or some type of non-current investment, or maybe even selling an intangible asset. In this problem, we didn't sell any assets at all, so that's why I put a zero here in that category. We're going to also look to see if we had paid out any cash for investing activities, such as buying a building or equipment, buying fixed assets, or buying some type of long-term investment in a company, or even buying intangible assets. What we did have was the fact that we bought a fixed asset, which was our equipment account. If you'll remember, they told us in the additional information that a building was, excuse me, wasn't equipment, it was a building. A building was constructed for $579,600. Do you see how that decreased the cash account? That is considered to be an investing activity because our buildings are a non-current type of activity. And that's why it goes in the investing activity section under what we are going to subtract from the cash that we received. Since we didn't receive any cash at all, the net amount of the investing activities is negative. We only paid out for our investing activities. We purchased a building with our cash. And so our net cash flow from investing activities is a negative amount. The next section that we're going to look at is the cash that we received from financing activities. We're going to look to see if we issued any long-term debt. And we did. In this case, we issued long-term debt, but we also issued some stock, I believe. So I'm going to go to what is said as B74. Let's look and see what B74 says. B74, we received some cash at $224,000. And so that's what we would have recorded here. If we look at our stock, we didn't actually receive any cash from the sale of stock because if you'll remember, we exchanged a bond for our stock. And so this right here wasn't attributed to a sale of stock. It was just that we had to give the stock up in exchange for the bond. You might remember that from this transaction right here. It didn't affect cash at all. So the only cash that was affected in this transaction would have been where we issued the long-term debt for $224,000, which comes from cell address B74. We're going to look to see if we paid out any cash back for our long-term debt, or maybe we paid cash dividends. I know that we paid some cash dividends, so let's look and see how much the cash dividends were. We paid out cash and dividends at $123,480, and that matches exactly the cash amount that we paid out. So we did not pay back any long-term debt in this particular problem. We did not acquire any treasury stock, but we did pay cash dividends. I think I'll highlight that for you so that when you go back and look at this, you'll know that's where that came from. And it's possible that I probably should have highlighted this too. So we issued some long-term debt here. And so the difference between these is the amount of the net cash flow that we used for financing activities. So we subtracted $123,480 from $224,000 to get this amount. On the statement of cash flows, we need to combine all of our operating activities, our investing activities, and our financing activity net amounts together. So what I did is I added the operating activities net amount of $561,400. I would have deducted out my negative amount for my investing activities, and then I would have added back the financing activities net amount to get a total increase in cash for this period of time of $82,320. When you get to this part of your statement of cash flows, you can check this amount with your balance sheet that we calculated the increase and decrease to the cash account on. You see it matches this amount here. That's how you know that your increase in cash is correct. To that increase in cash, we're going to add the beginning cash balance, which comes from the ledger. It also comes, in this case, from your balance sheet. Your beginning cash balance was $360,920. And then we'll combine that with our increase in cash, and that gives us the ending cash balance, which also should check back to what you've reported on your balance sheet at the ending balance sheet date, which was $443,240. And so that's how we prepare a statement of cash flows. So I'm going to stop here, and we will see you next time. Bye-bye.